This will change your life because I know 98% of traders don't pay attention to this, and that's why they blow their account successfully. Listen traders, there is what you are supposed to pay attention to before taking trades so that you can overcome smart money tricks. Let me show you what I pay attention to. First, before taking trades and traders, I call it inducement. Identifying inducements is one of the most challenging and key steps in market structure analysis that every trader encounters. Inducement zones are a hidden weapon used by institutional players to manipulate market sentiment, and they can turn a promising trade into a nightmare. Hence, recognizing valid inducements becomes a critical skill as it enables traders to distinguish authentic order blocks in the market, steering them away from potential traps and enhancing overall trade decision-making. Today, in this advanced episode, we'll unravel the secrets behind the inducement zones, understand how they work, and most importantly, equip you with the knowledge to protect yourself from potential losses. Now let's start with the basics of price behavior in the market. From the market structure perspective, price movement comprises three primary sub-movements: impulse, corrective, and continuation. Each of these sub-movements is already composed of internal candlestick formations. Now let's get into the details of each one. Impulse movements are characterized by strong directional price moves in the prevailing trend. During an impulse, the price advances decisively, often forming significant bullish or bearish trends. This phase is typically fueled by strong market sentiment and a dominant force, either buyers or sellers. For example, consider a bullish series of candles. As illustrated, we see that the price has formed a series of minor candlestick-based impulse and corrective movements, driving upward until it reaches a swing high. It's crucial to view these bullish internal structures as a unified bullish impulse leg. The rationale behind this is that the price hasn't taken out or effectively swept the liquidity of any previous minor and internal lows at this point. Nevertheless, considering the candlestick perspective, this internal move is identified as our impulse move. Subsequently, we have a valid pullback as the price has broken and closed below the latest bullish candle, marking a red bearish candle known as a minor correction. Additionally, we see another impulsive move termed as the minor continuation. It's clear that price has followed similar patterns until it reaches the swing high and forms a deep correction in this example. Now let's move on to the corrective movement. Corrective movement, in essence, is a counter-trend or retracement phase that temporarily opposes the main price direction. Therefore, from the market structure perspective, in the bullish scenario, a corrective movement occurs when the price breaks below the internal pullback or internal low, or when the price effectively sweeps its liquidity with a candle shadow. In this case, we see a correction represented by these three red candles, indicating that the price has broken out and swept the liquidity of the previous pullback's lowest point. Subsequently, we see that the price has pushed to the upside and eventually has broken out the latest swing high. Hence, we consider that as a continuation movement in a parallel scenario occurring in the second candle series. Once again, we see that the price has created a series of minor candlestick-based impulses and corrective movements toward the upside until it entered into a temporary pause, retraced back down with these three red candles. Since the price has not broken the lowest point of any internal pullback or internal lows, or it has not swept the liquidity below them in this sequence, we cannot consider it as a valid corrective movement either. So we should consider this price action scenario as a single impulsive movement without a correction. These concepts are applicable to bearish markets as well. It's important to note that these principles can be applied across various time frames and any price action-based chart. In the second section of the video, we will explore various inducement types, price actions associated with inducements that you might encounter in the market. Now let's proceed to the next topic and discuss how to identify a valid inducement in terms of candlestick patterns. We'll explore the criteria and rules that need to be considered for this analysis. In the bullish scenario, a candlestick-based inducement occurs when the price breaks below or effectively sweeps the liquidity of the lowest point of the bearish candle, representing the most recent valid pullback. For example, in the given illustration, we see that the price has created successive minor and internal impulse and corrective movements before entering the retracement phase and experiencing a temporary downward movement. With these three red candles, the price has broken and closed below the latest internal pullback, indicating a valid inducement and confirming the upper high as our valid major high. Similarly, in a bearish scenario, a valid inducement occurs when the price breaks above or effectively sweeps the liquidity above the most recent internal pullback, confirming a new major low and already a new break of structure. If the price breaks and closes below the newly confirmed major low, it's crucial to note that for having a confirmed inducement, the price must break and close above or below the most recent major high or major low and form a valid break of structure. If you look at the bullish diagram, you can see that the price has broken out and closed above the latest major high, indicating valid inducements and also a valid break of structure. Here we have identified a valid break of structure. Now, after the break of structure, where is the potential inducement area? We can see that the price created an internal pullback before it broke and closed above the recent major high. So in this case, the lowest point of this red bearish candle becomes an inducement and we are expecting the market to retrace, back down, take out and sweep the liquidity below it and confirm this high as the new major high. After mitigating the extreme demand zone, it should reverse and continue in its upward direction, also creating a new break of structure by breaking and closing above the most recent higher high. Before delving into the next topic, it's essential to consider some crucial points when identifying candlestick-based inducement on your price chart. To identify a valid inducement, as mentioned earlier, the price must take out the lowest point of the bearish candle, signifying the most recent valid internal pullback. This can happen either with the body closing below or with a wick that sweeps liquidity below the candle and then retraces within the range of the lowest point of the latest pullback, as illustrated in diagrams 1 and 2. In contrast, as depicted in the third diagram, the price did not succeed in surpassing the lowest point of the latest internal pullback, either with a body closing below or effectively sweeping the liquidity below it with a wick. Consequently, we cannot regard it as a valid inducement. Rather, it signifies a single impulsive movement. Now let's understand the importance of considering inducement in our trading strategy and why it's crucial to identify and highlight inducement areas on our price charts. Listen traders, before you make any big mistake, like paying for that expensive course, try reading this book first. This is basically what you are going to be taught by your mentor. In fact, not even everything. If you are a beginner and you have learnt only basics, don't dare funding your Forex account because you will not like the results. This book will introduce you to another side of Forex trading because you cannot like forever buy at support and sell at resistance. This book comprises of everything you need to know about smart money concepts and price action, and everything is explained simply. Grab your copy at $10 only and it will save you from a lot rather than paying for now. If you want to kick off your Forex journey, WhatsApp this number to order your copy. First come, first serve.